What do you know about alternative assets? You may or may not know that managers of large pension funds have been steadily adding to their allocations of alternative assets for decades now. There's no simple definition of what an alternative asset is, but the most easily understood definition might be anything that's not a publicly traded security like a stock or a bond, or an instrument that holds stocks and bonds like a mutual fund or an exchange traded fund. Until perhaps a decade ago, most portfolios were constructed using 100% publicly traded securities: stocks, bonds, mutual funds, and exchange traded funds. Only in the past 10 years or so have alternative assets been making their way into the portfolios of retail investors. Now, a moment ago, I said that anything non traditional might be considered an alternative. At this point, it might be useful to itemize the options in the alternative universe. They include structured notes, infrastructure, long short market neutral strategies, private real estate, private equity, private debt, and specialty instruments like clean energy projects and music royalties. In most instances, these are options with strong cash flow that are attractive to investors with a moderate risk appetite. Pension funds, endowments, foundations, and the like have gravitated toward alternative assets because they have an extremely long time horizon and will sacrifice liquidity in pursuit of higher returns. About a decade ago, regulations changed and a wide variety of alternative assets became available to retail investors. Many alternative products are available only through a structure known as an offering memorandum, or an OM. That's normally open to so-called accredited investors. Accreditation is seen as a proxy for sophistication. Many of these products are less intuitive, so regulators, in their wisdom, allow them to be purchased only by sophisticated investors. And since there's no reliable way to test for investor sophistication, regulators had a series of tests an investor would need to qualify for in order to use them. The four major tests are an annual income of over $200,000, a combined income with your spouse of over $300,000 a year, a willingness to invest at least $150,000 in a single product with no questions asked, or a portfolio of net liquid assets that is in excess of $1 million. The change in 2015 was that investors not otherwise accredited could also access these products if they worked with a portfolio manager. So, what's a portfolio manager? That's a subset of all advisors who, through study and experience, are allowed to exercise discretion on behalf of their clients on a fiduciary basis. There are only a few thousand portfolio managers in Canada today. Because many of the things held inside an OM product are not traded on a daily basis, many products available via OM are only priced at the end of the month. Accordingly, if you want to buy an offering memorandum product, you'd need to get your order in before the end of the month in order to get a trade in on the last day. And similarly, if you put an order in to sell an OM product, you would likely be asked to wait until the end of the following month before getting your money out. Practically speaking, that means most people have to wait 30 to 60 days to get liquidity on most OM products. That's not bad because finance shows there's often a liquidity premium, meaning things cannot be sold quickly to generate higher returns because of that constraint. In addition, many alternative products are weakly or negatively correlated to traditional asset classes. Adding alternative assets to a pre-existing portfolio often improves risk-adjusted returns. People who want resilient portfolios that can withstand a variety of market shocks with increased exposure to alternatives makes sense. As always, no product or strategy is perfect, but judiciously adding alternatives to your portfolio is often a good way to smooth out your investing experience.